Welcome back, listeners. My name is Larry Kulvig, founder and CEO of the Haven Financial Group. And if you're just tuning in, you're listening to the Haven Financial Group radio show, where weekly we discuss crucial retirement and financial topics. Today, interest rate cuts. How does it affect you? Kyle Thomas is on with us, certified financial planner on the Haven investment team. If you have questions or you're hearing something that rings a bell, feel free to give us a call at 612-504-8400 or visit us online at havenfinancialgroup.com. All kinds of retirement tools, our calendar of educational events, which we continue to have throughout the rest of the year. We believe education is extremely important, and it's how we meet and it's how we help a lot of people through that educational process.
We're talking about the Federal Reserve and how they cut interest rates about a week and a half, 2 weeks ago. It was the first cut that we've seen in 2025, but most likely will not be the last. There is anticipation that there will be 2 more cuts before 26. It was a quarter of a point, and Kyle Thomas has said to us that he's anticipating 2 more quarter of a point rate cuts. Correct, Kyle?
Yes, that's correct. And right now, the federal funds target rate is about 4% to 4.25. They always have a variation there, and we would expect that to go down another 0.5% or so since this last September one by the end of the year.
Sure. Well, we're talking about how that impacts retirees. And we said in the last segment, a lot of people think that this is just fodder for economists, but that's not necessarily the case. This can have an impact on everyone, but certainly those who are already or very close to retirement. So let's talk about some of those impacts. First, Kyle, maybe you'd want to address this: maintaining purchasing power. This can affect your everyday living.
Yes, and it's affecting every single person that is living here. I looked up, what are the biggest things that have been impacted by inflation these last few years? And it's housing costs, groceries, and gas. So I think every single person that is living right now is affected by at least one of those, and probably all of them. So everyday life is going to be hugely impacted by inflation, especially because those prices never typically come back down. They always tend to stay, where they were at. Gas is a little different, right? But groceries are probably not going to come back down in price. Rent's probably never going to come back down in price. Utilities are probably never going to. So it's a huge impact, and those costs will continue to receive inflation each year, even though that inflation number maybe isn't to the amount that it was these last few years. They will still increase in price annually.
And how is it that someone who's in retirement can protect against the idea that grocery prices are never going to come back down?
Well, with that, we have to try and manage what our returns are and our investments are the best we can, and to try and hedge for those types of inflation measures. And some of the best way to do that is to try and find investments that hedge against those directly. We have an investment within our portfolio called Treasury Inflation-Protected Securities. Your return on those bonds issued by the Treasury is directly correlated to inflation. Then we also have some fixed index annuities. Those are great for hedges against inflation because you have no downside risk, but you also have a guaranteed return. Right now, we're seeing about 7.75%. So that's a great way to hedge against that inflation and potentially, negative market returns. You just have to have the conversation with someone who's able to present these options, and someone like us, who we're an independent. We're not proprietary to anything. We can open our investment options up to pretty much anything that's out there.
Mm-hmm. Absolutely. Another way.
It really always comes down to your income sources. Maintaining the income necessary for the things that we all need, like Kyle mentioned, groceries and utilities and housing and all those things we need. But then our retirees that retire, they probably want a lifestyle also in retirement, kind of important. Maybe it's Do I have to scale back the number of vacations? Can I not play as many rounds of golf? What are the trade-offs? These are the discussions that we're going to have, but it's all been part of our proprietary planning process throughout the whole time. So it's not like this is surprising. It just takes some current reflection to talk through the things that we've already talked about, reminding our clients that we adjusted for this. We knew this was eventually coming. Yes, it may be times that seem a little uncertain because a lot of retirees are on a fixed income, and those pensions or fixed annuities, or maybe even Social Security, doesn't necessarily keep up with how the inflation and what that is. And one that I almost say weekly is healthcare costs. Right. Inflation in the medical sector always outpaces the general inflation number. Mm-hmm. And it makes it very difficult for long-term care discussions, rising insurance, medical premiums, which they're not going down. And annual enrollment is going to be coming up shortly. I encourage people to have a partner that can assist you in that area. Isabella and Glenn at our office do that, just to make sure you're in the right types of plans, because healthcare is a major expenditure in retirement.
So can between the two of you, give us maybe some examples of misconceptions about inflation and interest rates that people have?
Yeah, well, inflation has a misconception that it's all inherently bad, which it's not. We actually do want inflation within our economy. It's healthy for the economy. It drives growth within our country. And we just don't want it to be at 8 or 9% like it was back in 2022. We want it to be, well, the target right now is about 2%. That's what the Fed is targeting. But anywhere from 2 to 3 is probably an ideal target for that, because historically it's been hovering closer to 3, especially over these last 10 years. So that is a huge misconception about inflation, and inflation also does tend to help drive the stock market too. So when inflation's higher, the stock market tends to do better as well. So the inflation is good to a degree. We just want to make sure that we manage that, and that's what the Fed's job is there for, to make sure that it doesn't get out of hand.
And so, what about some misconceptions about interest rate cuts? And what do people, sort of think they're going to automatically see, and they frequently do not?
Well, with interest rate cuts, it's important to make sure that our interest rates aren't too high as well, because what the Fed's doing with the higher interest rates, they were trying to slow down the economy. We don't want our economy to have to be slowed down. So when those cuts are coming in, yeah, maybe it's less income for you on your bond portfolio, but it's going to be better overall for stimulating the economy, because there's going to be less borrowing costs. It's going to throw more money into circulation, and people are going to be able to not have to pay as much for certain things. And the stock market, like we said earlier, is going to have a positive reaction to lower interest rates. So the trade-off is there. Yes, less income, but better benefits with lower interest rates for sure.
I think a lot of people believe that the minute that the interest rates are dropped, they'll see a drop in mortgage rates, and that maybe this is the time now, sell your house or go out and buy a house. What do you tell people about that?
Well, the mortgage interest rates, they act sort of independently, but they also act dependently on what the Fed's doing. So those rates are changing all the time as well, without any Fed action. But they will kind of follow the trend of whatever the Fed is doing. So there's always adverse reactions to everything that happens. When rates go down for mortgages, the home values increase. So you could get a better rate if you're going to buy your house right now, but the price of that home could increase as well. Right. So there's a trade-off for everything that happens. Mm-hmm. And if you're going to be selling or buying your home, I wouldn't try to play the game all that much on when the best time would be to do that. Obviously, if we have an 08, 09, maybe that's not the best time to be doing that kind of thing.
Sure.
But it seems like we have a stable economy right now, so I wouldn't really be trying to play games with that. But what I would do is just make sure that you have a financial plan for everything that you're wanting to do, and make sure that you stress test it for different inflation metrics, and make sure that your asset allocations are in line with your needs, and make sure especially that you have a good bond diversification with all these interest rate changes.
Now, if this sounds overwhelming to you, and if it does, that would certainly be understanding. Maybe it's because you need a partner who understands this, follows this each and every day, and can help to guide you in a direction that is most beneficial to you. Why don't you give the folks at Haven Financial Group a call? It's 612-504-8400. They would love to have you come in, sit down, talk to them about your portfolio, whether you have one or you don't. If you do, maybe it needs to be stress tested. And if you don't, then now is the time to put one together. It's 612-504-8400. When we come back, we're going to talk about investment management principles for retirees right here on the Haven Financial Group Radio Show.